Hi, good afternoon. My name is Laura Bryant. I'm the Business Development Manager for Castle Group here in Southwest Florida. Thank you for joining us for part 2 of today's webinar with preparing budgets and reserves. If you missed part 1, that is available on our website, and if you need that link, please feel free to email me. My email will be provided on the next slide. You'll go to the next slide, Rose. There you go, there's my email, and you can email me at info@castlegroup.com, either or. If you are not familiar with Castle Group, we are a full-service on-site property management company located throughout the state of Florida. We have 7 different offices. If you need further information or are in need of any management services, feel free to reach out to us. We'd be happy to help. I'm going to pass off to Stephen, our Director of Community Association Accounting, and so he can introduce himself and talk to you a little bit about our presentation today.
Thank you, Laura. Good afternoon, everybody, and welcome to our presentation. I hope that everybody is doing well under the circumstances with this pandemic. As you know, my name is Steve Needleman, and I've been with Castle now for some time, and I oversee the day-to-day accounting activities. I'm going to pass next to Matt. And Matt, please forgive me if I pronounce it wrong. Is it Colsile?
Close, but it's Queasley, but no one ever gets it. So please just call me Matt.
You know, usually I'm pretty good with names, but he's with Resource Advisors, and he's going to fill you in on everything you need to know about reserve studies.
Right. Thank you, Stephen. My background is a civil and environmental engineer, but I've been doing reserve studies now for 20 years. Been with Reserve Advisors that entire time. I oversee the southeastern United States, Florida, the Carolinas, Georgia, Tennessee, and a few other states that don't have quite as many condos, but very, very well versed in Florida specific requirements. Florida is a very unique place that we'll talk about some of the unique requirements that we have for reserves or reserve studies, and hopefully answer a lot of your questions today. So thanks for joining us today. Mark, I'll turn it over to you.
I'm Mark Gerstel, a CPA. I have a firm that does audits and forensics, so certified in financial forensics. And we have offices in Fort Myers, Orlando, Miami, and Boca Raton. And we've been around since the mid-'80s, working predominantly on condominiums, turnovers, things like that. So thank you for inviting us.
Thank you guys for all being with us.
Okay, so we will now get started with the budget process, and we want to start off talking about planning. Usually we start to plan right around this time of year. June is usually when you want to start the budget process. To do it earlier than that would be a little premature. I've seen communities go much later than that. Typically you don't want to go past September because you're going to run into a time crunch when you're trying to schedule things such as the 2-week notice, which we'll get into, different types of meetings, things of that nature. So when you're planning your calendar, you want to work backwards from the date that you think that you're going to have an adoption of your budget. So you're thinking in terms of notices, you're thinking in terms of committee meetings, workshops, and you're also thinking in terms of the documents you need to look at. Most importantly are who's involved in the budget process. You're putting your team together. You're going to have your property manager, maybe there's a regional person involved, certainly the president, the treasurer, anybody else that's involved, perhaps a finance committee, unit owners may want to participate, and certainly your outside consultants, your CPAs, your reserve study friends, anybody that's going to have any impact on that process, you want to make sure they're available. So then you're going to set up your meetings. You're going to put together a financial review. You're going to figure out who's doing contract review, who's doing special projects. Everybody that's on the team wants to be involved in one aspect or another with a little bit of specialty. Can you go to the next slide?
Hey, Rose, can we go to the next slide, please?
Okay, we can go past that. Okay, so I believe I saw on one of the questions, people asked about a format of the budget. Typically, this is what you're going to see. It could be a little bit more elaborate than this, and this is very scaled down. What you have in your budget is going to be the heading. You want to specify the period of time that it covers from the first day to the last day of the period, number of units, name of the community, obviously. Usually, you're going to show the prior year budget. If we're doing this in June, you'll show the first 6 months of the year. Then we'll project out the balance of the year. That'll give us basically a forecast for the whole year, and that will then lead into the proposed budget for next year. Now, it's not uncommon to have additional columns here. For example, if you're looking between the total 2021, let's say, forecast and the budget, you may show a column for what you're increasing it by, decreasing it by. You may have percentages because you want to track how much things went up. So this is just the very basics. And here we have revenue broken down, a little bit more detail. If we can go to the next slide, we'll get into expenses a little bit. So here, this is a little bit more detail of the expenses. And we could drill down further after this, but these are common categories that you're going to have: administrative, utilities, contracts, insurance, repairs and maintenance. And I also include special projects. Special projects, I would think in terms of things that are not going to be repeating every year. And there's little technical reasons why you might want to track that. And in addition, so those are your operating expenses. You also have reserves, assuming that you're not going to waive them. And usually, at least in the condo world, you're going to have roof, painting, paving, anything that's $10,000 or more, and it's going to exceed 1 year. And those would be your typical expenses. We go to the next one. So in terms of your financial statement.
Hey, Steve, it's Laura.
Hi.
I've got a quick question that came in. How is depreciation usually handled?
Depreciation is typically handled like any other line item. It's really a non-cash flow item, but it does affect the budget. You know, it's an expense that's recorded every year. So you would, I'm sorry, go ahead.
Yeah, I can jump in a little bit. I mean, one of the things that we would recommend is, everybody looks at the revenue and expense, but I would start really with the balance sheet. And that says we have what is our equity, what is our balance, what is our receivables for bad debt. And as far as depreciation goes, pretty rare that an association will have fixed assets. It's more common, let's say, a country club. And so typically we have reserves or an operating, and everything gets against one of those or charged against whatever fund is supposed to pay for it. So usually there is no depreciation, and certainly I've never seen a budget for depreciation because, again, as Steve mentioned, it's a non-cash item. Usually you budget for, vehicle replacement, reserves are operating, or capital leases in reserves are operating, and that's where you charge the expense, we don't capital assets. But going back to the original point, it's very important to look at your balance sheet and make sure we know what our equity is and what it should be. Our is this example of $90,000 a month. Our rule of not cash, but our fund minus liabilities should always equal at least 1 to 2 months or 10% of the budget for operating. And then we can look at our project to the end of the year, make sure cash equals, but starting with the balance sheet is very, and I would not budget anything for depreciation.
I think we have a slide here after this one. If you can go forward a little bit. There we go. So that's the first page, and there is a second page, Mark, if you want to speak to that.
Absolutely. Starting here, I go down and I look and see what my cash is, and again, then cash and my receivables. And the first thing I'm going to look for is is my cash, over 250,000 in any place? Is my investment policy in effect? I'm sure reserves are probably CDs. I know there are questions on reserves to minimize income tax, and the only thing we'll say there is that one association that actually invests to reduce increases, but most I see or sweeps or private insurance. Then I look at my receivables. I want to see if I'm going to have any bad debts. Doesn't look like I have any association, but if I do, normally I have a couple of units not paid, and so in my budget, you have to budget for what I'm not going to collect next year. So I'm going to see that really in my receivables. If I go down to the page now, just as a stop, our total operating cash is $325,000. If I could go to the next page, go back.
There
Back
we go.
in.
Yeah. One more up.
There we go. So
Right.
my cash of $325,000, I compare to my operating, I'm back there, the operating fund equity, the balance, which is a different number because it includes, receivables and prepaids. But my equity, if we go to that next page.
Rose, next page. Hey, Mark, you're kind of coming in and out with audio. I may have you mute your computer and call in via phone with your participant ID.
Okay. Are you hear me better now?
Yes, sir. It just kind of comes in and out at times.
Okay, sorry about that. But again, here we look at that operating fund equity. Here it's 285,000, even though my cash is 325. And again, if I'm spending 90,000 a month, I don't want that to get too big or too small. Here I'm at 285, so I've got almost 3 months covered, which is a very good operating position. I can budget very tight, and I still see here I have reserves and I have a special assessment going on. All this activity could affect your budget, and you're only going to see it on your balance sheet. Again, some of the questions were, what is the differentiation between a special assessment and loans? And quite often we see them work in tandem. When I have a big assessment, and like here's a $10 million assessment, a lot of times that's collected over time, and I'll need a construction loan during the project where I'll start off with a line of credit for a build out period. So I only borrow what I need. And then then it will term out to a number of years. And so as I bill and collect it, I use the bank money for the expenses and then the assessment money to repay the loan. But all this information, I see I have about $1 million in reserves. All this information starts on the balance sheet, even before I look at how am I doing on my budget, profit or loss. I can see here that for this year, I have a $16,000 over budget. And what's important is that because of recurring misses, or is that because of one-time misses?
Okay, I've got a quick question that came in, Mark, from Jerry. He's asking, with the new revenue recognition requirements, are you handling special assessments differently from this point forward?
We're really handling the special assessments exactly the same as now we're handling reserves. The new revenue ruling basically said that reserves are no longer considered part of equity. They're really considered a liability because what they are is deferred revenue until we spend it, which is the same as a special assessment. Well, if I build, for example, on the special assessment, $10 million in December, and I hadn't spent any yet, I don't recognize any until I start spending it. So it stays up as a deferred liability. Now reserves are basically treated the same way, even though you budget for them the same by putting in, let's say $100,000 a year, we don't recognize it until it's spent. So it comes out of our equity and it's now considered a liability, which you guys have it shown here as a liability, because it's not permanent. It's going to be there, but then it's going to be spent. Whereas operating is theoretically permanent. It's always there because we budget to break even, and reserves and assessments come in and go out. So, the new revenue ruling treats reserves just as special assessments, as a deferred revenue until spent.
I've got one other question. So to help understand the recent FASB slash ASC 606 regarding the HOA reserves, can you help explain that?
That's exactly what we just said, that the
Yes,
606
Yep.
now takes reserves and says it's no longer part of your fund balance. It's not equity. Used to be we had two fund balances, an operating and a reserve, and it was considered equity. Now they move it from equity up to a liability. So it looks like, if I have any loan covenants, it looks like my equity went down tremendously by just moving reserves out of equity into a long-term liability, something that's going to be spent. But again, reserves are now considered as money that I'm just holding, like a savings account, but it's not going to be permanent. It's going to be spent, guaranteed, because that's how we're predicting to collect it, is on how we're going to spend it. So 606 just says reserves are no longer equity. It's considered a deferred revenue, what they call a contract liability. We just call it deferred reserves. And it's recognized for GAAP purposes as spent, not as budgeted and collected.
All right, great, thank you.
One I'd make is, here we have a special assessment. If you have assessments, you usually have more than one thing going on. Even in concrete, I'm going to have, engineer and a contract. And we would always recommend that you use what's called contra accounts, that concrete restoration expense, a number with a negative. If I have 5 items in my assessment, I'd create 5 expense items so I can keep painting from roofing and, whatever, air conditioning, so I can see how I'm doing against each line item in the budget. Because if I go over on one, I know I have to adjust for that in the others.
Great.
And I would just add one other thing, Mark, which, if you'd like, you can elaborate on. Under the new 606 rules, they did treat interest differently. So you'll notice that there's reserve fund only for interest at this point.
Right. The 606 only applies to the assessment, the money we raise from the owners. It doesn't apply to the reserve interest. So reserve interest is recognized every year as earned, where the reserve assessment is only recognized as spent.
Great. I've got another question that came in live from Cynthia. Can a bank use our reserves as collateral with the new ruling?
Absolutely, a bank will use that, but I've never seen them really use it as collateral. They may have a restricted cash to protect that they get paid, but the collateral usually is tied in the association's collection ability, their authority to assess. And what they judge interest rates on is really not the total number of my accounts receivable, but how many units out of 100% are delinquent. If I have more than a 10% delinquency ratio, then I'm going to find it very difficult to get any loan. If I have no receivables, I can get a loan even though I have no reserves. So they really focus on that authority to assess more so than the cash in the bank as collateral, because they know that that money is going to be spent for the projects.
Right. I know we had several questions come in regarding lines of credit. So should we obtain a line of credit for potential income loss as we're preparing for budgets for 2021?
Well, that's a tough one, if I could speak to that. I've been working with a number of banks, and in light of the pandemic, a typical comment I've been receiving from the banks is, well, if the unit owners aren't paying you, how do you know we're going to get paid? So they're a little gun shy about lending under those circumstances. That they're happy to set up emergency lines of credit. Some of the banks, what they are doing is they're pegging them to specific events, such as a named catastrophic storm. And then what they do is they look to the insurance proceeds from that as their collateral. Alternatively, and as Mark indicated, that they more typically they will look at the receivables. They will have a first line of first lien rights on that, and they'll look to the special assessment. They'll look to the general assessments of the association as their collateral. And if I'm not mistaken, and Mark, if you could clarify this, I think in the case of condominiums, I don't believe that they can even pledge the reserves as collateral, can they? Because
they can
wouldn't that
pledge-
be tantamount to using it for a reason other than what it was originally intended to be used for?
Again, depending on your pooled or straight line, you could pledge your roof money for a roof project. But if you're straight line, you know, two things, one on COVID and one on lines of credit. Our experience so far, and it's early in the game, is that COVID is really affecting, mostly on the receivables and the people's ability to pay the money. And so that brings out bad debt and whether I need to increase my bad debt and whether I have sufficient operating capital to make it through this year. Lines of credit usually are not used for, collection issues. They're again usually used in projects where I want to front the money and then assess or assess over time and do it right away. But in an extreme case, again, I would, if I realize that my delinquency rate is now 10 or 20%, then you absolutely could use a line of credit to stabilize cash flow. But then we have to do either an assessment or modify the budget because that loan has to get paid back.
Right. One of the
Right.
questions that came in prior was, do you do a line of credit versus a special assessment? Which ideally you don't want to special assess, but you're not going to use a line of credit to make up for the association income, right?
Right. Again, line of credit is just a temporary fix. It's only I still have to either assess or raise the budget to pay it back. So it's only a temporary reprieve. Usually, if the increase is going to, my shortfall's a recurring problem, like I'm not collecting my maintenance fees, then I'm going to adjust my budget. If it's a temporary problem, like a project that is running ahead of schedule, then I certainly use a line of credit. A lot of times the line of credit will then term out into a loan. But we've also seen line of credits established in the case for insurance deductibles or uninsured losses. Some very conservative associations actually have a reserve for the insurance deductible and uninsured losses. But most times people only want to put in what they know they're going to spend, and they don't want to quote unquote leave any money behind in case there's no hurricane. But it is a reserve that we have seen. Or we've seen them with a line of credit in case all of a sudden I have a storm and I have to get something done right away.
You want to move on, Steve? I have plenty of questions coming in. I've got another one. If you've got a robust plan for capital improvements and money in the bank to pay for those, right now this association has placed those projects on hold due to the pandemic and not knowing, what their costs are. Because I know we have lots of associations who have had increased costs due to the pandemic with cleaning and additional staff. What's your advice to restart this, projects if you've got money in the bank specifically for the project, but you're worried about what the pandemic or how the pandemic will affect your budget?
Well, again, what we would recommend is that, we always have to take care of the operating fund and the day-to-day expenses first. I have to have insurance, I have to have payroll, I have to have utilities. The projects, to the extent they're not life safety related, theoretically can be reprioritized. So, we would always say, let's get through the uncertainty and then we can move forward. One of the things we kind of got off on is the whole budget process. And one of the most important points that I want to make sure we reiterate is it's not only the projection of numbers, but to us, it's the documentation and the line item notes or the schedules for all the items in there. What is the scope of each one of your contracts? What are my, what is my labor or payroll, my job description? So the more notes and permanent records we can have and just roll forward year to year, one of which is the reserve study, which is probably one of the most important tools we can have. But a permanent record is an important thing to develop each year as you go through your budget process. As we analyze each line item in the budget and make notes towards it, we also start thinking about, what are our policies and procedures for internal control that make sure we know how much we're ordering or how much we're authorizing in overtime and things like that. So all that is kind of developed as we go through each line item in the budget.
Very good. We want to move through some more slides here, Steve. Okay.
Okay, so now we get into what you would see for a typical straight line component reserve schedule. Perhaps Matt wants to jump in on this.
Yeah, absolutely. And there's some great questions there about reprioritizing. We've been working with a lot of our associations trying to figure out how to reprioritize maybe some of these reserve projects as well because of shortfalls in other areas. One of the things with
Matt's audio went out.
reserves, as I mentioned, there's a lot of restrictions in Florida. For condo, oh, can you hear me?
Yeah, your
No?
audio's, your
All right,
audio.
It froze there for a minute.
I'm going to try dialing in on the phone here too, but is it okay now?
It is.
Yeah, we got you.
Okay. Sorry about that. So with the reserves, as I was saying, they're restricted in Florida. So condominiums and homeowners associations that have statutory reserves can only be used on their authorized purpose unless voted approval by the majority of the owners in advance for their use for another purpose. So that's something to consider as you say, well, maybe we'll hold off on painting or roofing.
Nope. Matt just got muted again, or he's going in and out. I apologize for that.
One of the things that Matt's going to talk about, obviously, is the reserves, which is a whole different
Project.
section.
You may need to get a
He's going to call in, but operating and reserves are totally different. There's a 115% rule in condos that I think a lot of board members know about, thinking that there's this magic limit that they can only raise it. That's only for the operating budget, doesn't include reserves. But there's huge differences in the statute and in your planning and funding, whether you're using straight line or pooled. And I think those are concepts that have been around for a while. The basic reality is that straight line, as we have a schedule here, means that each component is separate and one can't be used for the other. Again, in this example, if I have a $535,000 roof, if I have $335,000 already accumulated, that means I need $200,000. If I have 5 years to fund it, that means I have to put in $40,000. That's why it's straight line for the next 5 years to get my $200,000. So that's a calculation that has to be done for reserves when they're on the straight line. Many associations like the straight line because of the rigidness of the categories, and they don't have to worry about future boards going, offline. But it becomes difficult because, again, if my roof actually costs $635,000, now I've got a problem. I can't just borrow it temporarily from the paving, which is going to last 10 more years, and then adjust my future funding. I got to go out and get an owner vote. If we could, the other reserves are the pooled method, which we can go maybe to the next page.
Mhm.
And here you're going to see, instead of, I see the same roof, painting, paving, but now when I look at this spreadsheet, my beginning balance and ending balance is only one number. And the reason that is because everything has been combined into one category. And instead of dividing it out now by the unfunded balance by the life, I now project my cash flow that I need to contribute every year so that I never go negative in my ending balance. They call it a balloon payment. We would call it a special assessment. So you always want to be able to fund that enough that you can deal with all these items as they come due. Now, one thing that may come under consideration, a COVID consideration, is there very well may be less contractors to do the work, and therefore the prices in these reserve studies may be way understated. We've seen experience a lot where the prices are low and the lives are maybe too high. Welcome back, Matt. So we were just talking about, pooled versus straight line, Matt.
Yes, yeah, and I was able to hear. Can you hear me okay now on the phone?
Yes.
Okay, great, and yeah, that's right, Mark. There's some contractors not available. We've also seen some communities though that are taking advantage of contractors that are trying to keep busy. where other jobs may have canceled, and they're actually trying to keep work and offering some discounts or timing advantages, which they weren't before. The pooled reserve does allow that fluidity, which is very, very important for a lot of associations to have some flexibility in their funds. One note here is that the items are still restricted to those 5 components listed in the pooled schedule. You cannot spend money on a different item that's not currently in the reserve schedule, just as you couldn't spend in the other methodology roofing money on a painting project. One of the big things I want to take away as we're starting to turn into that budget season, getting to the point now where we're starting to look at this is, when we don't reserve or when we inadequately reserve, what happens to our communities. And after doing this 20 years, I've also been on my condominium board for 13 years. I can tell you having reserves is one of the most important ways to fulfill that fiduciary duty that each board member has, and to be a good steward of the property. The communities that have reserves now going into a potential economic downturn, like I just mentioned, may be able to take advantage of lower contractor rates. They may be able to put more back into the community and increase the curb appeal, increase the safety, perhaps do some things to modify the usage of the common areas to make them more safe and accessible for all the members without having to special assess. Because as governments, little governments, we are the little condominium associations and homeowners associations, we cannot really spend more money than we take in. So our options are typically to fund, with the money we have, to special assess. There are some opportunities to get a loan, which kind of turns into a longer special assessment, in my experience. But the least expensive way to fund our capital projects is actually by saving for them ahead of time. So we hear a lot of people say we couldn't afford to be fully funded. We couldn't afford to have the reserves where we need them. And those are usually in cases where the previous boards have not been the best stewards and have not gone ahead and raised fees to a point where they need to be. And the question that we have to ask ourselves, if we find, if you guys, your boards or your managers find yourselves in those situations, is how are we going to afford the special assessment? How are we going to afford to repay the loan if we can't afford the normal monthly assessments to take care of our items? There was one of the questions that was sent in ahead of time. I kind of got a chuckle out of is, that we paid for this the first time. Let the future owners worry about this item. I'm not going to be here. Why would I want to set aside reserves for an item now? Because I've already paid for that item when I moved in. And it's an interesting concept and a lot of very common mindset that boards and members of communities get into. But I would just challenge you as a board with that fiduciary duty. Your concern is not where you're going to be in the next 5 or 10 years. It's where the community is going to be in the next 5 or 10 years. It's where the Condo Association Inc. is it going to be standing? Is it going to be in good shape? Are the values of the homes holding where they should be? Are you maintaining the property? Is the safety still being secured in your community? Because you and previous boards and members have done the right thing and set aside funds for the items as they wear out. Each of us enjoys the use of our common elements when we live in our community every day. And some of us are spending a lot more time in our community associations now than ever. I know I am, and spending a lot more time there. You start to recognize, maybe some projects that need to get done, but there's constantly wear and tear, especially in such an extreme environment like we are here in Florida. That if we don't have the funds for those items, we can be really setting the community up for a difficult situation. So, do a reserve study. I think the biggest mistakes I see in the industry is that we don't have all the items on this list. And this example, it's my example, and I'm guilty of it here, is there's 5 items. And I can only think of a couple of associations that I've ever worked with that really only have 5 items that they have to worry about. Many are more like 25, 55, or 105 are much more common items. And that's where typically the surprises happen. So that's just, I think, not doing a reserve study opens you up to claiming you're fully funded or claiming that you have reserves for these items, but then opens up to a surprise expense that maybe we don't have the funds that we thought we had. Just a couple real quick ones that often get missed: concrete restoration, plumbing, and electrical systems, sometimes HVAC systems. A lot of balcony railings get left off of reserve schedules all the time. So if you have these items in your community, think about them. And then, don't put, I'd encourage you not to put just a reserve for your clubhouse or your swimming pool, because each of those items has many, many different individual components that you'd want to reserve for, likely. And without defining them, that money can get spent pretty quickly. And then again, leave your board or a future board with a surprise because there aren't funds available for a project.
Right. And speaking of projects, Matt, another thing that I've seen is if you're adding something, right? So if you've added a monument, if you've added gates, if you've added a playground area or changed a bocce court into pickleball courts, you need to have your reserve study updated at that time. So I had a question come in live by Wendy. How often or frequently should we have the reserve study updated? So assuming there's no changes to the association or any assets added, how often? And then obviously when things are added, you would definitely need to get it updated. So if you'll answer how frequently.
Yeah, that's great questions there. And frequency, each year, in Florida specifically, each year we have to create a budget, and each year that budget has to have a new reserve schedule with it. So, we are going to have to do an annual update of your reserve study at some level, or at least of your reserve schedule. There is no requirement anywhere in any of our statutes here in Florida to have a professional do this work, so you could do it yourself. And most of our clients, I would say, take our Excel spreadsheets that we give with the study and then update it internally themselves for a couple of years, and then hire the professionals to come out and physically examine the property every 3 years or so. For a newer property that may not have a lot of changes or a lot of projects going on, you may go a little bit longer. Older properties or certainly communities that have things that are popping up, either they've added them knowingly, or again, they find out about a project that they never had on their schedule and they want to update it. That would be appropriate. That's a common question I get is, can we just add something? And yes, the board generally can, if they find out that there was never balcony railings on the schedule, and that's certainly something they're going to have to deal with, they should go ahead and add that in their next budget schedule. And like with most things, it's not a requirement to do a reserve study professionally, but again, it's a best practice. Because as board members, unless you have a real strong background in every type of construction and engineering, it may be very likely that things are going to get overlooked or missed in your schedule. And if you're like me, you don't get paid enough as a board member to take on that liability.
Yeah, so what about the inflation factor? And I was going to ask you, are your Excel spreadsheets, can you adjust the inflation factor so that it will reflect within the entire worksheet?
Yeah, so inflation is really only taken into account on the pooled reserves typically. Component reserve is kind of a 1 year analysis that says that this year we're going to depreciate this. So we typically don't see inflated replacement costs in the component schedule, but we do incorporate that into the pooled schedule. Yes, it's part of the formulas that come with the Excel spreadsheets that we provide. One note of caution, though, there has been some interpretations by the Department of Business and Regulation that they do not want to see inflation on the contributions, the income to the reserve account. You'll see in this example on the slide, if you can see it, the first year, next year is $75,000, and the year after that is $77,300. The year after that is $79,600. Each of those is inflated 3%. The thinking being that future owners would pay more in actual dollars because the present or the future value of that dollar is the same as the present value. But the long story short, the Department of Business Regulation would like to see all of that be flat. So in a lot of our condominiums where they're subject to that interpretation from the DBPR, we've been taking the inflation out of the schedule for the out years to keep the contributions all in present day dollars. But it's an easy exercise to look at and certainly something to consider because costs are not going to stay the same. We can guarantee that over time there will be inflation. The exact amount is debatable, but we're working with some people in the department to try to get that interpretation clarified so we can allow some inflation in our schedules. But at this time, you'd likely be wise just to do everything in present day dollars for your formal schedule that you mail out to your owners.
Right.
And one thing, if I may, to keep in mind is this, you know, you mentioned that you're going to do this every few years or so. This is not a static schedule. If you're doing it on your own, you're going to revisit this each and every year. And usually on the remaining useful life number, that's pretty much the determinant on how many years using the pooling method, how far out you will go. So if you have an asset that's the longest remaining useful life is 23 years, you're going to have 23 years shown in that schedule. And more often than not, you're correct, that they don't like to see, from the state's point of view, they prefer not to see the inflation built into the funding, but it would make sense to me, you know, to deal with actual projected costs, because that's never going to stay static. And the other comment I wanted to make is if you have a community that has not yet switched over to pooling, then you have to think about it a little bit. The good thing about pooling, and I'm neutral on this, but the good thing about pooling is, as was mentioned before, those funds could be used for any of the components within the pool. Depending upon how you look at it, the bad thing is it could be used for any of the components in the pool. So you have to know your board, you have to know the demographics and you know, what the drivers are for the membership.
One thing also for the budget, I think it's very important to overlap your operating repairs and keep them in as much detail compared to the reserve items. We see, Matt, in a lot of your studies and furnishings, you know, there's a lot of little items in there, and I could be funding for little items in my reserves and also budgeting for them and charging them in my operating. So knowing what's really in the detail in both operating reserves and where do I code, you know, a $5,000 air conditioning bill or a $5,000, you know, roof repair, it's very important to know, you know, where I'm supposed to code it. You know, deferred maintenance, you know, repairs that happen as I go, not a complete replacement, but we see quite often a repair that quote unquote extends the life of reserve gets coded to reserve, so I don't have any operating deficit. But if you're not funding for deferred maintenance and you're only funding for replacement costs, there can be an argument that you can't use reserves for those, you know, patchworks to keep the item alive. So it's really important to know the details of what's in those components, not only on the reserve side, but also, you know, keep your repairs not in one general or one contingency, but break them out in as much detail, electrical, lighting, you know, as many details as you can on the operating side as well.
If I've got a couple live questions in regarding the pooled reserve method. Do you have to, if you're looking at pooled reserves, do you have to save the same amount each year, or can you fund the amount fluctuating year to year? So if you were behind, the goal would be proper budgeting.
You can, in a straight line, which is the separate, as it says, you have to fund the same amount if the numbers stay the same. You know, $40,000 a year if I take 5 years to do 200,000. In a pool that's, you can see Matt is done here, you're allowed to fund on an increasing basis, just as long as there's no, what they call balloon payment. So here it's going from 75,000, the next year it's going up to 77, then 79. That's perfectly allowable in a pooled method. And a lot of times when we switch over, those early year contributions are less than my straight line contributions, but no, at the end, they'll be more than your straight line contribution. So you have that flexibility in the pooling, you don't have it in the straight line.
Gotcha. And just some clarification on the pooled reserves, a question from George. Can these funds only be used for the projects that were initially included in the pooled?
Yes, for HOAs, condos, and co-ops, the language is identical in the statute that they can only be used for their authorized purpose unless approved in advance by a majority vote of the owners at a duly called meeting.
Well, let me just chime in. The only thing that you said originally in the list, obviously as you add tot lot or new items and now start funding on my list, even if it's only been in there 1 year, I can now use those pooled funds because it's now part of my funding. So It doesn't have to be originally in there. It's just as
Okay.
long as it's on my list and I'm funding it.
I've
Now,
got
I'd
another.
like to go back to,
Oh, go ahead.
I'm sorry.
Steve. No, go ahead, Steve. It's okay.
I wanted to comment on something that Mark mentioned before about the smaller items. Let's call them the one-offs. You know, maybe it's a $5,000 repair or something of that nature that doesn't quite rise to the level of coming out of reserves. That's what I had in mind for the special projects. You know, you may have an expenditure. You know, you have to replace pumps every so often, but they're not very expensive, whatever it might be. Those things you can certainly factor into the operating if you know they're coming up this year. But if they're not recurring, you want to isolate those, because if in the very, very rare instance where that 115% test would ever pop up, and I don't know that I've ever seen it, frankly, those items can be excluded from that test.
Yeah.
Just to back up on that, you know, we've seen, just my point earlier, you know, but association will budget one thing for special projects, but they'll end up spending it on 5 different things, you know, or contingency. So we would very much recommend that you add a GL account for each one of those special projects, so I can see what I spent it on during the year. Otherwise, when I see it all in one number, nobody really knows what that is, and it's hard to know whether I'm gonna, after 6 months, have to double it, or if it just happened one time. So be specific in your coding, even though I may budget it as one number. As I spend it, show how you spent it in detail, so that, you know, we don't have to go back every month and remember what our special projects were for.
Yeah.
It costs nothing to add another line item in the chart of accounts, plus it makes it easier for next year's budgeting, because now you have better recall on what took place. I agree.
Yeah. As you sit down with your property manager, your manager will be able to know, you know, in your contracts, and they'll have that relationship with the vendor as far as what major maintenance or repair items do we have coming up in 2021 versus replacement, which would be more of that reserve, you know, line item. But I've got another question that came in. Is there a minimum reserve balance that you should have in any given year? For example, the deductible and a catastrophic insurance policy. I've got a lot of questions on, should we have our insurance deductibles and reserves?
So
Well, you know,
I can feel it. Go ahead, Mark.
you know, again, we don't really see insurance deductible, or even what's more common is uninsured losses. It may not be my deductible, it's just something like landscaping that's not covered. So we do see occasionally reserves for those components, but typically we don't, because again, that's not something we can predict and estimate the life and count on. So it would be outside that. Now, if I have a storm and I have a roof reserve and my roof was damaged, then certainly I can use my roof reserve for that hurricane damage, but not for debris removal or landscaping or things that, other things that have come up with the a hurricane.
Yeah, I have a little, I mean, I pretty much agree with that. I think that one thing we see a lot of is we do see a lot of separate reserves for storm cleanup or hurricane deductible. I would just encourage you to keep them separate, because I don't think they really meet the definitions that are in the Florida Administrative Code for reserve expenditures. They don't qualify as capital expenditures or deferred maintenance. They're kind of a separate savings account that you would establish, just like you might establish a savings account for an improvement or something that you wanted to do down the road. So it's really more working capital, I think, in that case, is what I would probably consider that, as opposed to reserves. The question on the threshold, and we point that out here in this example, that after the roof, you know, the reserves, the pooled reserves get down to a very low point. And the Department of Business and Regulation, our statutes allow us to take that all the way down to $0. As long as it doesn't go negative, the pooled schedule will pass muster. I always like to leave a contingency in there because that roof project could very easily go over by 5% if we see a spike in gas costs or petroleum costs. So, you know, a threshold is reasonable, but it's not necessary, and it's really a business decision on case by case per association on what you might want to have. We have many associations that want to go all the way down to $0 in their reserves because maybe they have a separate fund working capital for that insurance deductible. And then we have others that say we never want our reserves to drop below $500,000 because we have all these potential exposures that we don't have any other funds for. So it's really kind of case by case on what that threshold is, but it could go as low as zero for your associations to pass the stage requirements. Probably not a best practice.
Oh, go ahead. Oh, I've got, like I said, I've got lots of questions coming in. So a question, how do you set up new reserves for an HOA or condo?
I think these are just set up as part of the budget process. You'd add them to your reserve schedule, and then when the budget is approved, typically that's done by the board. Then they're part of the schedule for the following or going forward from that point of view, from that when that budget takes effect.
Right. I think that the point that Matt made was that, the Florida law is the minimum that you can do, but you can exceed the minimum by adding future projects or hurricane deductible and basically add things, in your funding and in your budget at, for any year that you want. That's a board decision. They could add items. The only thing the owners could do would be vote to take items out, but it's not a restriction that they can't add more. Now, obviously, if they add ridiculous items, lobby do every year, then they're going to, raise the maintenance fees and get voted out. But you can absolutely add items, each year as you go, as, we're going to do a fob project or life safety or sprinklers or whatever it may be, something that wasn't considered in the past.
Okay, so with the pandemic and COVID, if an association decides to spend money from the reserves due to the result of the pandemic, is that allowed, even if it was not voted on by the board, depending on?
I don't think anybody's going to say you can do that. Again, if you say spending it for COVID, if you spend it, for increased security or cleaning or whatever it may be, obviously those are operating. And the only way that can be done is to get a vote of the owners in advance. If there is an actual hurricane, you have emergency powers that I can do what I need to protect the association. But for something like COVID, which is not unexpected, it's a long drawn out process, you wouldn't be able to use reserve funds for, operating shortfalls unless you go out and get an owner vote, which can be done, pretty easily, and say, we want to, use $100,000 from our pooled or from our paving or whatever it may be, if you're straight line, and get an owner vote. And there's no problem with that.
Great.
The only thing is, if we do use reserves for whatever reason that wasn't anticipated, we do have to, realize that that's going to mean that we have to adjust the funding, even though, because the study didn't include that. In 2021, Matt thought we could put in 75,000, but if we know in 2020 we used our reserves for something that wasn't anticipated, I better put more than 75,000 in 2021.
Got a quick live question that came in, and then we're going to kind of do some best practices recap real quick because we're running short on time. In regarding to what you just mentioned, is the owner vote 100%, or is that depending on the documents?
Majority of the voting interest. So 50% plus one.
Okay. All right, thank you. I know this hour flew by, guys. We've got about 5 minutes left. If each of you would just we'll start with Mark, some of your best practices and key points on as we go into reserves and budgeting for 2021, and any recommendations in regarding what we should do differently, knowing and not knowing really what the pandemic will, give us through the rest of 2020.
A couple of things. Number one, as I stated, make sure you know what your operating equity is, your fund balance. A lot of times we've seen associations doing a surplus rollover, even though they have a deficit. Number two, put in as much documentation as you can as far as describing, landscaping, how many cuts a month, the scope of the work, elevator. Put in as many notes as you can as a permanent record so that the subsequent year's budget process is a lot simpler. So documentation and have a minimum operating fund balance. And we would also recommend a minimum reserve fund balance, never go below whatever, 100,000, 500,000 you want, because there are a lot of unforeseen things. And usually the one thing that gets everybody is special assessments. So that's what we try to avoid if we can. East Coast versus West Coast. East Coast usually votes out reserves West Coast usually always funds reserves conservatively. We found that to be very true.
That's good to know. Steve, any last thoughts?
Sure. Know your expenses. Be aware of what's going on from the operating point of view in terms of contracts. You may have built-in automatic renewals, 4%, 5% on certain things. It could be cable, whatever it might be. Be aware the utilities are going up. Certainly insurance, expect to see increases on that. In terms of schedules that you're going to work with, you'll look at your financial statements. We talked about the balance sheet, the income statement. You may recall one of the earlier slides showed month-to-month comparative. Those are useful schedules if you can have that, because it will show you the blips that come along that you weren't anticipating. Or maybe something, if you're first budgeting in June and a major project that you budget for each year hasn't occurred until, or doesn't occur until August, take that into consideration. So look at the trend analysis as well.
Wonderful, thank you. Matt?
We didn't really even talk about the two of the most important things in the reserve studies. I just want to put those out there, getting the right costs and the right useful lives in the schedule. And I mentioned the other biggest one is get the right items on the list. So those are kind of the three best practices. I think most in our industry strongly recommend using an engineer to help you with this, because you don't know what you don't know, and you don't want to be surprised by those items. Been doing this a long enough time to remember 2008, 2009, and those communities that had insufficient reserves were hit generally much harder than those that had sufficient reserves, and those that had good reserves weathered the storm much better and really separated themselves in the value of what they do. So special assessments in hard economic times are just a perfect storm, I guess. So if we can, let's avoid them, and just, let us know how we can help. You got a great team, with Castle and Mark and others are around you. So I'd rely on that professional assistance as you put your budgets together this year.
Yep, and when you have your reserve study done, hopefully you do, have your maintenance supervisor, your property manager walk the property with that engineer. Make sure they know where everything is, because it's going to be the first time they have their eyes on the property. So make sure that engineer, is doing the inspection, not the full inspections, but at least so the manager and the maintenance supervisor can point out things that they may or may not know about. Great conversation, guys. Thank you so much for your time. This slide is available. You're welcome to email us at info@castlegroup.com. I'd be happy to share it with you, and I will forward our panelists' contact information if you're interested. And we thank you again for joining us for part 2. Part 1 is also available. Again, just email me, and I'll be happy to share that information. Thank you, gentlemen.